Good afternoon, everyone, and welcome to our weekly webinar where we will talk about what we see happening in the global economy and financial markets and the world of wealth management, and certainly how all of this impacts our decisions on the best courses of action for your investment strategy and your financial goals. Thank you for taking the time out of your busy schedules to join us. We're recording this so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and I'm joined by my partner and colleague, Paul Tepsich, the founder of HighRock, and our financial planner, Bianca Tomlinson, is on the call as well. We will have a question and answer period at the end of the call, so if anyone has a question about portfolios or any aspect of wealth management, we invite you to feel free to ask questions. Well, once again, I am live from Point of Barrel, Ontario, on the northeastern shoreline of the beautiful Georgian Bay. Unfortunately, this is going to be the last call from here because, as all good vacations, as it happens for all vacations, they do come to an end. But it's been a staggeringly wonderful couple of weeks up here, and it's been very enjoyable to be away from the city. But I am away from the office, but always tuned in thanks to the wonderful world of technology. And so there have been a few interesting developments this week, which we'll talk about, but generally, outside of China, financial markets and economic developments are relatively subdued as we head into the normally heavy vacation month of August. For those listening for the first time, HighRock was founded by Paul in 2010 to manage about $200 million in closed-end funds for Scotiabank, and we are registered with the Ontario Securities Commission. I joined Paul in April to help build our private client business, and we're excited to have our unique business model making an impact as we add new clients on a weekly basis. Now, if you like what we are doing, our approach, our service, our expertise, feel free to recommend us to your friends, your family, and colleagues. We do have room for new clients who might be a good fit to our style of low-cost investment and wealth management. Our private client division was established to take advantage of some of the synergies that come with the funds we manage for Scotiabank. We are not brokers, we are not investment advisors or financial advisors. We are a portfolio management company who has a clear understanding of wealth management. Now, importantly, all of us at HighRock have our money invested in the same models as all of our clients. Whatever we do for all of us. Our interests are aligned with yours. Our fees are simple and transparent, and we fully disclose any hidden or embedded fees, unlike most advisors. As well, we take our responsibility to beyond what is required by the regulators with an independent review committee that reports directly to our clients to ensure that we're fulfilling our obligations. The first report was sent with our quarterly update, and your portfolio progress report will be sent each quarter to you. Well, after 6 years of above average performance for client portfolios, managing risk is now more important than ever because we are in and may be in a lower return environment for some time. We take risk management very seriously because we must be always vigilant not to put our clients' money at greater risk in order to chase higher returns. Our ongoing efforts for the management of your portfolio strategy is to find the best possible returns while simultaneously providing the least amount of risk in doing so. Naturally, this is done in the context of each of our clients' specific goals and their tolerance for risk. Now, our research shows that a globally diversified and balanced 60% equity, 40% fixed income model can significantly reduce risk and still achieve annualized returns of between 7 and 8% over a multiple year period. This is what we consider to be the optimal portfolio. However, after a multi-year period of above average returns, we also have to rein in our expectations, knowing that there is a greater likelihood of below average returns on the short-term time horizon. Well, at HighRock, we have three models to create balance and diversification. We have a fixed income model with bonds, a small percentage of which might be high yield. We include preferred shares here as well. We have a global equity portfolio that focuses on diversification across thousands of companies in multiple economic sectors and across many geographic locations. And as well, we have a model that focuses on Canadian small to mid-sized companies with which we have a great deal of familiarity and deep levels of research. This is an active or tactical model intended to obtain better than average growth. For our clients, we use these models to create portfolio strategies that are in keeping with your desired goals. So each week we look at our broad themes for 2015 and what, if any, new information has developed that might be impactful. Well, one of our key themes and our overriding theme this year is basically to expect surprises. And it has been a year that has not been short on those. Oil prices began the year making multi-year lows, but stabilized in April through June, but broke down a couple of weeks ago and now look to retest those lows as supply continues to outweigh demand. Well, with Canada's already struggling economy, the Bank of Canada has dropped the bank rate twice. And as a result, the Canadian dollar has been impacted significantly, and it is suggested that it may continue to trend lower, and we have to be wary of this. It is why we try to have a portion of our client portfolios held in US dollars and, of course, in international companies to provide that diversity that helps to reduce potential volatility. With an increased likelihood that the Canadian dollar may fall further, there is always a time lag between how that lower currency value impacts Canadian exports and eventually helps to rejuvenate the Canadian economy. But the recent plunge in many commodity prices has exacerbated this impact on the Canadian economy at the moment. Well, our assessment of interest rates and what may be next for the Bank of Canada, there are some suggesting the possibility of another rate cut later in the year. Canadian short-term rates are partially building in that bank rate cut. At the same time, further out the curve, we look and see that 10-year bond yields have come back almost to their April 20 lows. As you can imagine, this is not suggesting any economic strength in the near term. In contrast to that, just to look at the UK and how their yield curve has steepened, where we've seen better economic data from that country, and the Bank of England Governor Carney has suggested that they may in fact raise interest rates in the not too distant future. Well, Bank of Canada Governor Paul Oz is hoping that a stronger U.S. economy in the second half of 2015 will improve the potential for the Canadian economic recovery, especially in the non-energy related sectors. However, that would mean we will need to see some significantly better U.S. economic data. We introduced a new sub-theme a few months ago, which we think needs to be part of the conversation and will impact the U.S. economy significantly in coming years. And basically that's that baby boomers, the former big spenders, are now entering retirement and their consumption habits are changing. As well, the millennials, the largest cohort now, have generally less money to spend and have very different consumption priorities. We've seen retail sales falling in the U.S., and as the consumer is 2/3 of the U.S. economy, we think that this may be a significant structural adjustment that will impact the U.S. economy in the future. And what of the U.S. Federal Reserve? Well, as we've been talking about quite a fair bit, Fed Chairwoman Janet Yellen is rather more upbeat about the outlook for the U.S. economy than we are, and continues to suggest that at least one interest rate increase is coming in the U.S. in 2015, perhaps September, but there is a good chance that economic data may postpone this until later in the year, possibly December. How is this all affecting bond markets? Well, we saw what's been going on in Canada and the UK, but in the US, expectations of higher US interest rates have moved bond yields higher out the long term, and in the short term have already built in a 25 basis point increase in the shorter end of the yield curve. In Germany, yields are still negative in the short run, but certainly they are off their high points in the longer run. Well, we are now well into second quarter earnings season, and second quarter earnings continue to come in with mixed results. Now, while more companies are reporting better than expected earnings, those earnings were revised downward earlier, so earnings on the whole continue to decline. And as well, revenues are declining, and in fact, revenues aren't expected to resume any growth until well into 2016. So that, to us, tells us that the fundamentals are just not assisting, and we think stocks remain expensive. And as we've said many times on these calls, we believe that they are expensive relative to company valuations because of simple supply and demand factors, where share buybacks have reduced the supply of equities, and investors looking for better returns have increased their exposure to risk. So less supply, greater demand, and it's pushed prices higher, but well above what we think represents decent value. Equity markets have calmed since the culmination of the Greek crisis. However, we still believe that overvalued markets mean a correction is coming, and it's been a while since there's been a decent, significant correction. So this just makes us remain cautious at this time. Well, how are we positioning our portfolio models based on our assessment of the current environment? In bond markets and fixed income, volatility has settled, but we are, again, only looking to add when we get only looking to add positions when we feel that yields have moved to a point where it makes sense. In our global equity market, again, volatility has eased up, but short-term downtrends in most markets have resumed subsequent to the Greek crisis. So we're monitoring those situations very closely. Although volatility has eased up a little bit since Greece, we are, again, still cautious. And let's look at a few of the markets that we do follow. So the S&P 500 tried to push to new highs with the Greek relief rally, but could not make those new highs. And now they're testing the short-term uptrend from last October. Really, without any new positive catalysts and any fresh buying, this market's going to continue to struggle. And with the fundamentals not providing any catalyst at all, in fact, looking a bit soft, the S&P is basically unchanged on the year, and we have a feeling that it may head into negative territory before long. Lower commodity prices have hurt the TSX despite lower interest rates, and that commodity situation continues to unfold as the global economy continues to weaken, and certainly issues in China are catalysts for that. On the international scale, Japan is also struggling to keep its highs made earlier. An attempt, again, similar to the U.S. after the Greek crisis, but lately they have slipped. In the UK, despite better GDP data that we saw this morning, the UK is still trending lower. Euro stocks could not make new highs after the Greek resolution. They're continuing their downtrend as well. And a similar story exists in Australia as well. So internationally, all those markets are still trending lower, and we are cautious as a result. What about China and emerging markets? Well, China's been a big story and the biggest story this week. We have seen the downtrend resume with the biggest one-day drop in Chinese equity prices since 2007 occurring yesterday. Of course, the sentiment in emerging markets amidst this is not good, and emerging markets have moved to their lowest level since 2011. So again, all of this gives us reason to remain cautious, looking for better buying opportunities further down the road when we think that these downtrends are resolving themselves. But at this point, we're not feeling like it's time to commit. Paul, if you're on the call, do you have anything you want to add about the Canadian growth equity markets and model? Paul, I know, was taken away by a call, so he may not be on today. So if that being the case, we will certainly update everybody in more detail next week. But just from an overall perspective, I can say that while we see some value beginning to happen with lower prices in the Canadian equity market, something that we certainly, Paul was on BNN talking about a few weeks ago. We do still remain cautious with our new ideas, but monitoring them closely and looking for opportunity there as well. Okay, that's basically all I have to put in there today. If anyone has a question, we're wide open here. Please feel free to ask now. All right. If you have no questions, or if you do have questions and you're listening to the recorded version, please feel very comfortable emailing us, and we would be more than happy for you to send them. All right, that's it for another week. Thanks for taking the time to tune in. Have a great week, a wonderful weekend. Hope you're all enjoying the summer weather. We'll return with another webinar next Tuesday. Unfortunately, I'll be back in the office, but this is Scott Tomlinson signing off.